So let's get started with today's session. I have sent you an Excel sheet for all of you, which I am going to discuss today. Right? This Excel sheet contains case studies, mini case studies. These are all financial problems which you will find in your day-to-day life if you are an analyst, and that's why we pick them up. Right? So most of us, before we get into this financial modeling case studies, I would like to clarify a myth. Most of us were made to believe that financial modeling is equal to company valuation. Most of us believe this, or were made to believe this, right? This is a myth. Financial modeling has its application in a wider area. So don't believe in this myth, financial modeling is equal to company valuation, right? So let me give you some examples of where and all this can be applied. For example, this can be applied in things as simple as your personal wealth management. Personal wealth management. For example, if you were to calculate your car loan EMI, a financial modeling might be required, right? You might want to find out how a asset depreciates, right? So there you might want to do a financial modeling. For example, if let's say you are a portfolio manager and you want to create a heat map of what to buy and what to sell every day. This can be automatically done by an Excel, right? So if you are a portfolio manager and if you want to do performance attribution of your portfolio, then it has to be done with a financial modeling, right? So financial modeling has a very, very wider application in terms of usage. So it's not just company valuation. Company valuation is one of the many uses of financial modeling, and in fact it requires a skill set which is not even 25% of the entire financial modeling spectrum would demand, right? So with this brief introduction, let me move on to today's discussion. I will take certain mini case studies which are all things that you have come up in your day-to-day life, and I will tell you how to approach them and model it in Excel and easily handle it, right? So first case study, table 1 below contains a set of transactions that happened in a portfolio. The investor decides to withdraw the portfolio on 25th November 2012. Calculate the annualized return for the period. Calculate the absolute return for the period. So let's understand before even, so let's see the numbers first and then we will get on with the discussion. So we have a set of transactions. So all the negative numbers indicate investment, that is a cash outflow to the investor. The investor has an outflow, so he invests. All the positive numbers indicates the investor is withdrawing the portfolio. Alright? So before we get on, let's understand a few things. Let's do a simplistic example. Let's say 1/1/2012, somebody invests 100 rupees, and on 30/6/2012, he redeems the same portfolio for 120 rupees. So he invests 100, takes out 120, right? So what is the return for the period? The return for the period would be 120 divided by 100 minus 1. So it's a 20% return, which is the absolute return. Whereas if you were to annualize it, then you can find an IRR. You can find an IRR which would give you 44.4%. So the essential distinction you need to make here is your absolute return, and absolute return is different from IRR. Return is different from IRR. So IRR is annualized, whereas an absolute return is for the period. It does not contain any annualizing, right? So let's extend this example actually and think of it in such a way that, so let's say instead of 36/2012, he withdraws this on 31/3/2013, 31st March of 2013. So what happens here in this case, the absolute return remains 20%, whereas the annualized return has decreased because the period has been longer now. Earlier it was 6 months, now it is 15 months. So an absolute return will not change because of the time period in between a cash flow, whereas a annualized return will change according to the time period for which investment has been made, right? So most of us use this formula called IRR, which is internal rate of return, for finding out the return. But most of us forget this IRR is annualized. So if you want to find out return for a given period, then this annualized return has to be converted into periodic return or absolute return. So that is the primary objective of this case study. So we have to convert this annualized return into periodic return. So let's see how we can do it. So in most cases, see for example, if there is no cash inflow or outflow in between a year, let's say this cash flow. So let's say in this case itself, we invested on 1/1/2012 and we withdrew on 31/12/2012. In this case, the absolute return would be 2% and IRR would also be 20%. So absolute return and IRR will be same. So this function in IRR will be applicable only if the time period between cash flows is equal to 1 year. The time period between each of the cash flow is not 1 year, then a formula called IRR in Excel cannot be used. If the time period between cash flow vary from 1 year, then we have to use a formula called XIRR, which is also an IRR, but for cash flows with unequal intervals like this. So in this case, the first cash flow happens on 1st January, second cash flow happens on 1st March, then on 1st June, then on 25th July, then on 30th August, then on 15th September, then on 30th October, and then on 25/11 November 2012. So 1 year is not completed, right? So in this case, when the interval between cash flows is not equal to 1 year, then we have to essentially use a function called XIRR. Again, remember, XIRR will also give you annualized returns, right? So let's go ahead and calculate the XIRR for this portfolio. So all the cash investments are negative and all the withdrawals are positive. So for example, he invested 400,000 on 1st January and withdrew 100,000 on 1st March. So on and so forth. The final withdrawal is 3,100. So let's go ahead and calculate the annualized return using the function called XIRR. So type XIRR, open the bracket and open the function. So what are the values? The cash flows are the values. So you select all the cash flows and you select the relevant dates. So you selected the cash flows, you selected the dates. If you want, you can make a guess or you can leave it empty. So you get something called 14%, 13.92%. So 13.92% is the annualized return on this portfolio. So hello, am I audible to everybody? Is my voice clear? Is my voice clear to you? Okay, fair enough. So fine. So the annualized return of this portfolio is 13.92%. Great. Now this is not absolute return, right? So this is annualized. If the portfolio has been invested for full year, this assumes that portfolio was invested for full year. Whereas we invested for only close to less than 11 months, in fact, between 25/11/2012 and between 1st January and 21st November, which is less than 11 months. So the actual return for the period is going to be less than 13.92%. So how to convert this? So for that we will use, there is no straight function, so we'll use mathematical functions. So how many number of years are there between 1st January and 25 November? So you have to subtract 25/11 minus 1st January to get, there are 329 days. If you divide this by 365 or 364, you get 0.9 years. So 0.9 years is where the portfolio has been invested. So to convert this into absolute return, all you have to do is 1 plus 13.92% power number of years for which it has been invested. It is 0.9 years. You do that and subtract minus 1. So the absolute return for this period has been 12.46%. So what this number tells is, the 13.92 number tells is, if the portfolio has been remained invested for the entire year, it would have generated 13.92%. So this is a notional number, right? So it says if it has been remained invested, then 13.92% would have been earned. Whereas the actual return is 12.46%. So you invested for 11 months, so you got 12.46%. So that is the reality, right? So that is the difference between annualized return and absolute return. This can work both ways. So for example, if this is 25, 12, so instead of 2012, if you withdrew it in 2013, so then in this case, for the entire 1.9 years, you earned 8.76%. But for an year on an average, you earned for 4.5%. So that can change. So in a sense, the other thing that you need to remember is absolute return will be greater than annualized return. Annualized return if investment period is greater than 1 year. If investment period is greater than 1 year, absolute return will be less than annualized return. If investment period is less than 1 year. So that is the crux of this case study. The learning in this case study are one, when to use IRR formula, that is only when the cash flows have equal interval of 1 year. And when the cash flow intervals are not equal, then you should use the function called XIRR. The third learning is IRR and XIRR are annualized. So if it is annualized, then how to convert it into absolute return? How to calculate absolute return, right? So these are the learnings that we would have from this case study. This is a simple and straightforward case study, but still most of us will get confused when it comes to IRR and absolute return. So that is the purpose of clarifying, that is the purpose of this case study, right? So let's move on to next case study. So table 1 contains details of a machine that was purchased by a company at the start of year 1. Calculate the carrying value and depreciation for the machine for each year using double declining balance and fill the table, right? So double declining balance formula has been given. So let me quickly explain what is double declining balance and what is straight line depreciation. So a straight line depreciation, so let's say you buy a machine for 100, the cost of a machine is 100, right? And salvage value, what is a salvage value or a scrap value is after using it for several years, you can sell the useless machine for, let's say, 10 crores. So after using it for several years, you sold it for 10 crores. So that is salvage value. So the useful life of the machine is, let's say, 9 years. Useful life of the machine is equal to 9 years. So in this case, the depreciation each year will be given by cost minus salvage value divided by life of the machine. So cost is 100, salvage value is 10, life is 9. So 90 by 9 equal to 10. So the depreciation every year would be equal to 10. This is with respect to straight line depreciation. Depreciation every year will be same. Under SL depreciation, all year depreciation will be same. all years depreciation is same, right? Whereas under double declining balance, we will have a slightly different approach. So let's calculate the straight line depreciation for a moment, and then we will go to double declining balance. So starting carrying value, so let's say the purchase value here is 5.5 million, scrap value is 800,000 and useful life is 5. Let me calculate the straight line depreciation first. Straight line depreciation. So in this case, the starting depreciation, starting carrying value, that is the value of the asset that is being reported in the balance sheet, is 5.5 million. Depreciation will be given by cost, the original cost, minus salvage value divided by useful life, which is 5. The ending carrying value will be starting carrying value minus the current year depreciation. So this year's ending carrying value, so first year's ending carrying value will be equal to second year's starting carrying value. So the second year's starting carrying value will be 4.56 million, which is equal to first year's ending carrying value. The depreciation in this case is again going to be the same, which is 9.4. So if we continue for the entire 5 years, what you can see is every year the depreciation remains same. At the end of the year, at the end of 5 years, the carrying value of the machine is equal to scrap value. This will automatically come to scrap value because of the formula we used, right? This, instead of doing this manual calculation, Excel has a straight formula to do straight line depreciation. You have to type S, L and N, which straight line depreciation will be given by a function called SLN, straight line. It's a short form of straight line, SLN, right? So open the dialog box. The cost of the machine is 5.5 million. The salvage value is 800,000. Life of the machine is 5, right? So enter this, you get the same number 9.4 and you get the same answers as we got earlier, right? So you can either use the function or you can do the calculation on your own to calculate this depreciation. The important point to notice here is the ending carrying value automatically becomes scrap value using straight line depreciation. So let's move on and calculate double declining balance now. The double declining balance, the depreciation will be given by starting carrying value into depreciation rate. Depreciation rate. Remember, in straight line depreciation, we always used original cost, cost minus salvage value by life, right? This is straight line. So in all years, we use the same cost, same salvage value and the same life. Whereas in double declining balance, we are going to use starting carrying value. So this starting carrying value, as you can see here, is going to be different every year. And hence your depreciation calculated is going to be different every year. That is another important observation that you should have. That is, under straight line, all years depreciation is equal. But under double declining balance, depreciation every year is going to be different, right? So let's go ahead and calculate this. Let's go ahead and calculate this double declining balance. So let me also clarify how to calculate that depreciation rate. So I just made a statement DDB equal to starting carrying value into depreciation rate. So now what is this depreciation rate? Depreciation rate will be given by 1 by useful life. 1 by useful life into 2 for double declining balance. If it's a triple declining balance, this number will become 3. If it's a quadruple declining balance, this number will become 4. So in our case, the depreciation rate will be 1 by 5 into 2, which is equal to 40%. That is the rate of depreciation in our case. So starting carrying value into 40% will be our depreciation in our case, right? So let's go ahead and do the calculation. So I will delete this. I'm going to do double declining balance here. The starting carrying value The starting carrying value is 5.5 million. The depreciation, as we just discussed, is going to be starting carrying value into 40%, right? And ending carrying value, starting carrying value minus that year's depreciation. The second year's depreciation, the second year's starting carrying value is equal to first year's ending carrying value. Second year depreciation now is going to be 3.3 million into 40%. Right? So now this depreciation number is different. First year it is 2.2 million, second year it is only 1.32 million. So the ending carrying value is 1.98 million. So let's go to third year. The starting carrying value is 1.98. The depreciation is going to be into 40%. And the ending carrying value is 1.188 million. So let's continue with that. So you depreciate it by another 40% and you get the ending carrying value of 7.12 million. Now you depreciate it for another year and then you get the ending carrying value of 0.427 million. So now this is tricky, right? Why it is tricky is we know that the scrap value, that is the value of machine, the value of useless machine that can be sold is for 800,000. The useless machine can be sold for 800,000. But the carrying value is only 0.427 or 427,000 is the ending carrying value. So the double declining balance sometimes will cause a problem wherein this value, the ending carrying value, is less than scrap value or salvage value. So if that is the case, then we have to manually intervene and change this, ensure that this never goes below 800,000, right? So how do we intervene and tell this? We have to use a formula, right? So what formula will we use is, so we have to use a if formula, right? So if the starting carrying value minus depreciation for the year, if starting carrying value minus depreciation for the year is less than 800,000, then we have to take a depreciation which is equal to the starting carrying value minus the scrap value or the salvage value. Otherwise, we will use this formula which says that starting carrying value, which says that depreciation equal to starting carrying value into 40%. Alright. So, sorry, I think we have done something wrong. Just a second. So 792,000, if this is less than 0, then you have to depreciate it at 5.5 million minus the salvage value, that is the depreciation, right? So there is a small error there. So you have to use this formula and say if the carrying value drops below salvage value, then carrying value equal to salvage value. Otherwise, carrying value equal to starting carrying value minus depreciation. So if carrying value is less than salvage value, then carrying value will get equal to salvage value. For example, in this place, the carrying value drops below salvage value, right? And hence we are restricting the amount of depreciation that the company can claim. It can never drop below a salvage value. So that is the trick that we need to learn with double declining balance, right? So I will quickly do the formula again. I will take the questions again. For this purpose, I will do the quick formula once again quickly. Alright. So what I have done is equal to if this depreciation, if starting carrying value minus starting carrying value into 40%, which is the depreciation, is less than this scrap value, then the 30 years depreciation will be given by the starting carrying value minus the scrap value. Otherwise it will be given by this 5.5 million into 40%, right? So you drag the formula and you get the value. So this is if you manually do it, but Excel will make your life much more simpler. So because Excel has a direct formula for this. So let's delete this, and there is a direct formula called DDB, double declining balance, which directly gives you this formulas and will automatically make the necessary adjustments. So the cost of the machine is 5.5 million. The salvage value is 800,000. That is also something we know. The life of the machine is 5 years, right? So the period for which you are calculating, whether it is for first year, second year or third year. So I am linking it to the year here. So it's first year. Factor, if it's a double declining balance, you can leave it empty. If it's a triple declining balance, you have to put 3. Right? So I will leave it 2 because it's a double declining balance. And then you drag the formula. Here you need not manually intervene. It will automatically ensure that the value, the carrying value never drops below the scrap value. So this is something that you have to manually, ensure in your double declining balance depreciation calculation, right? So the two important learnings here is in double declining balance, the salvage value will not automatically become the ending carrying value. The ending carrying value will not automatically become salvage value in double declining balance. And hence, if you are using a formula, then you have to manually intervene through a formula and ensure that this carrying value never drops below scrap value. Or you can use a formula called DDB, which is available, and this will ensure. The second learning is SL depreciation every year is same all years. Whereas in DDB, the depreciation every year will change. And the second important point to notice is it will be higher in the first year and it will decrease at a faster rate. So it is 2.2 million, it almost becomes half of it and then almost becomes half of it every year. So the double declining balance will drop at a faster rate. That's why it is called declining balance, right? It decreases at a faster rate, right? So this is with respect to double declining balance and straight line depreciation methods. Let's go to the next case study which we have in front of us. So Mr. Rajesh borrowed rupees 50 lakh of home loan on 1st January 2012 at an interest rate. This is a floating rate because nowadays we all know that the interest rate on loan is floating. So he gets a loan which is linked to base rate plus 50 basis point. Basis points, 100 basis points will equal to 1%, or in other words 1 basis point equal to 1/100%. 1 basis point is equal to 1/100%, right? So when he borrowed the loan, the base rate was 10.25%. And he has to pay this loan in over 15 years in equated monthly installment, that is called EMI. Equated monthly installment is EMI, right? So over 15 years he has to pay this loan in monthly EMIs. So there are 3 tasks that we will do. One, find out what would be the EMI to start with, and what would be the principal that he repays every month, and what would be the interest that he repays every month. The second one would be, if the interest rate changes, what would happen? We will come to the second part later. First, let's find out how to calculate the EMI. Alright. So we all would have read from the textbook that there is a formula for calculating EMI, which would be given, which is also written here. I think I have deleted that formula. So no harm. So we'll go on. So this formula which we have in screen will give us the for EMI principal P equal to principal into rate of interest into 1 plus r power n divided by 1 plus r power n minus 1. So as you can see, this formula is not easy to remember. So don't worry. So Excel has some straightforward functions to remember, do this. So let's go ahead and use the Excel formulas and calculate this. So how many months are there in 15 years? So 15 years into 12 months gives us 180 months for us to repay the loan. So let's put the month numbers first. This is just for our reference. So there are 180 months. So there are 180 months. So he has to repay from first. He has to repay from 31st January 2012 because he bought the loan on 1st January 2012 and hence the first repayment will happen on 31st January 2012. So from 31st January 2012 he will start repaying the loan. The next one would be 28 to 2012, right? So if we drag this, sorry, this is a leap year, so 29 February 2012. So if you drag this, it will automatically fill up the month end numbers. So now what is the EMI? So EMI can be calculated easily using a formula called PMT, which is miniature version of payment. PMT stands for payment, right? So this has 5 arguments. So let's fill them one by one. So the first argument is rate. What is rate? Rate is interest rate. And N per. N per is number of periods in the repayment years. So there are 180 periods because we have to repay it over 180 months. The PV stands for present value. The present value of the loan is 50 lakhs, right? Future value is nothing because at the end of the loan you don't have to pay anything. And the type stands for whether you pay at the beginning of month or end of month. Beginning of month or not, right? So these are the 5 arguments that you have to fill. So let's fill them one by one. So to start with, what is the interest rate? The starting interest rate is 10.75%, right? So how do we get this 10.75%? The base rate is 10.5. The base rate is 10.25%. And the rate on loan will be given on base rate plus 0.5% or 50 basis points. So which makes it 10.75%, right? So 10.75%, but remember this is an annual interest rate. This is the annual rate. That is the important thing you have to notice. This is an annual rate. So we have to convert this into monthly rate. To convert this, you just have to divide this by 12. So convert this by dividing this by 12. Number of periods is 180, we already know. Present value of the loan is 50 lakh. 50 into 10 power 5 will make it 50 lakh. Future value is 0, so leave it empty. Type whether you are paying at the beginning of the month or at the end of the month. So since we are paying at the end of the month, as you can see from the instruction here, for end of the month you have to put 0. For payment at the end of the period you have to put 0. So I will fill up 0 here. And this is the EMI. So he has to pay 56,047.4 every month to repay his loan in 180 months. So this value will remain constant every month. So every month if he pays 56,047 to repay his loan in time, right? So let's understand what is going to be the principal portion of this EMI every month and interest portion of this EMI every month. Right? So the principal portion of this EMI can be calculated using a formula called PPMT, which stands for principal payment. PMT stands for payment, principal payment. So PMT stands for payment and hence P stands for principal, right? And IPMT stands for interest payment. I stands for interest and PMT stands for IPMT, right? So let's calculate the principal and interest repaid. So I'll use the same formula, PPMT. The same set of arguments will come. Rate is 10.75% divided by 12. The period is for which month you want to calculate the EMI, whether you want to calculate it for first month, second month or fifth month, for which month you want to calculate the EMI. So here we have put the month numbers just for this purpose. So if I want to calculate the principal repayment in first year, then I will link it to the first month. If I want to calculate principal repayment in the first month, I will link it to the number 1. The total number of period is 180 months. So it has to be repaid after over 180 months. The present value is 50 into 10 power 5, which is 50 lakh. Future value is something that we do not have, and we are paying at the end of the month, so we put 0. So what this tells is, first month out of this 56,000, 11,000 goes towards principal repayment. Second month out of 56,000, 11,353 goes for principal repayment. If you go towards the end, in the 180th month, out of 56,000, almost 55,600 rupees goes towards principal. So as you can see, in the beginning months, the principal component is lesser, and as we go down, the principal component keeps on increasing, and towards the end, almost the entire money goes towards principal repayment. Let's calculate the interest. The interest can be calculated as IPMT. Again, the arguments are same. The rate is 10.75% divided by 12. The period is for which month you want to calculate the interest. Number of periods is 180. The value of the loan is 50 lakh, right? And it has to be paid at the year end. So you enter this and you get this much. So in the first month, out of 56,000, 44,791 went to interest repayment. So add this to the principal repayment and interest repayment that is calculated. That will be equal to the EMI you actually calculated. So both will be same. For all months it will be the same case, right? So also what you can see is, let's add all the principals repaid. Add all the principal repaid, you get exactly 50 lakh repayment. So if you add all these principals repaid, you get 50 lakh repaid, right? So this is how you have to work with calculating EMI, right? So this is the first part of the case study, wherein how to create the schedule of what is the, while the banker tells you what is your EMI every month, you can calculate what proportion of it goes into principal and what proportion of it goes into interest yourself. There is a simple tool called PPMT and IPMT available for us. Also, if you were to take a loan and if a bank has quoted our interest rate is 10.25%, you yourself can automatically calculate what is the EMI for you, right? So let's go to the second part of the case study. The second part of the case study is on 1 year later, exactly after 1 year or after 12 payments, on 1st January 2013, the bank revised the base rate to 10.75%. The base rate has been increased, right? Now, because of this, when the interest rate increases, you can have two options. One, you can increase your EMI. You can increase EMI and keep remaining number of means constant. So for example, originally there were 180 months of repayment, out of which he has repaid for 12 months. So which means he has to pay for another 168 months. If he has to finish the loan in another 168 months, then he has to increase his EMI if he were to repay it in 168 months. Or the second option is he can repay the loan at the same rate of 56,047, in which case the number of months will increase. Number of months will increase beyond 168 months, right? So you have two options now. Either you can keep the EMI, either you can increase the EMI and keep the months constants, or keep the EMI constant and increase the month. One of this has to increase. So he wants to understand, Rajesh wants to understand, if he increases the EMI, how much will be the new EMI? How much will be the new EMI? Or if he reaches the EMI constant, what will be his new number of months? New number of months. So these are the questions in front of Rajesh. So let's try and find that out. To find that out, the first thing we need is, what is the outstanding principal? What is the outstanding principal as of 1st January 2013? So as of 1st January 2012, we knew that 50 lakh of loan was outstanding. Now on 1st January 2013, what is the outstanding loan? This can be easily calculated because we have the principal repayment schedule. So over the first 12 months, that is till 31st December 2012, the principal repayment is, if you add all this principal repayment, you have paid 1,41,926. So out of 50 lakhs, 1,41,926 has been repaid. So your original loan is 50 lakh into 10 power 5. And what you have repaid is 1,41,000, right? So the new outstanding loan is 48,58,000, right? Now you can calculate the necessary stuff. So what is the new EMI or new number of months? New number of months, both we can calculate. So the new EMI can be calculated again using the formula called PMT, right? This is the original formula we used to calculate EMI here also. So what do we do is PMT. The new rate now is 11.25% because 10.75 plus 0.5% divided by 12 because 11.25 is annual rate. Number of periods now is equal to 180 minus 12 months, which is 168 months. The new principal is the new present value. So the new principal is 48,58,000. We do not have any future value. So the type is going to be 0. So if he were to repay the loan, complete repaying the loan in another 168 months, he has to pay 57,544. Or in other words, he has to pay 1,500 rupees extra per month. If he were to repay the same loan at an increased interest rate within 168 months remaining, he has to pay 1,500 rupees extra for this loan, right? So what is the new number of months? The new number of months can be calculated using a formula called N per. So remember, when you calculated this EMI, you also had a N per argument here, right? We also had a N per argument here, which is nothing but number of periods. So now you want to find out the number of months in which you can repay the loan, for which you will use the function called N per. I'll open the argument. So we have 11.25% divided by 12. Payment per month is going to be 56,047. The present value is 48,58,000 and you are going to pay at the end of the month. So now if you have to finish the loan by paying 56,000 only at increased interest rate, he has to repay it for another 180 months, 179.5 or 180 months. Even though he has already repaid for 12 months, because of 0.5% increase in interest rate, he has to pay for another 180 months. So the total repayment comes to now 192 months instead of 180 months because of 0.5% increase in interest rate, right? So this is how you can approach the problem of EMI and how things will change when floating interest rate changes with respect to a loan. Fine, that is the learning from this case study. So let's move ahead. The next case study is on presentation, that is graphs. So what we have here is, refer the table 1 below, which contains selected financial data of Infosys Limited. Present all this data in a single chart. Use the best possible formattive. Effective communication of the message will attract more points. So in this case, we have to use only single chart and there are 4 set of information to be presented. One is sales, another one is sales growth, net income and profit growth. Generally, when you have to present this kind of, so these are all in different scale also. One is in percentage and one is an absolute number. So let's try and draw a chart out of it. So let's say I decide to draw a bar chart. How to draw a bar chart? So select the data, insert, column, and then go to 2D column chart. So I get a bar chart which is simple and straightforward. So now what the problem, if you notice here, is the net income growth, sales growth and profit growth are almost hidden here because those lines are in percentages compared to these numbers which are in crores. So these numbers are not visible at all, right? So how to make them visible? Because we need to read that trend also. So one thing that we can do to make them visible is to move them to second axis. So this y-axis is called primary y-axis. So now we can create a second axis here which will be called as secondary axis, right? So let's try and do that. So how to do that is, it's a very simple process actually, just that it has to come in our mind. So let's select this maroon line which belongs to sales growth. I click on that, so that series gets selected. I now right click and go to format data series. I click on the maroon line, right click, go to format data series. Now I have a tab here which says that plot series on primary axis or secondary axis. Now by default it is in primary axis. I am going to change it to secondary axis. So now it has moved to right axis. So that is fine. Let it be for the moment. So now we want to move the sales profit growth, net income growth or profit growth also to the right axis. So I select the profit growth, again right click, format data series and select secondary axis, right? So now I have moved it to secondary axis, but it is not readable at all. So what interpretation I can make out of this? This looks like a totally useless chart. And I cannot make any interpretation out of it, right? So what I can do is, to show the actual numbers, I will have a bar chart, and to show the trend, I will use a line chart because line charts are good in showing trends. So I go here and select for sales growth. I'm going to select the series, just click on the maroon line, right click, go to change series chart type. This is here, change series chart type, and now it is in column chart. I am going to select a line chart. So it becomes a line chart. Similarly, profit growth, I select it and right click, select it, whatever, right click, change series chart type and make it a line chart, right? So here I can change the axis also. I will put this and make it format axis and axis option. So minimum is going to be 0. So I put it as 0. So this is a slightly better chart now, right? We can still make this better. This is a slightly better chart. Now there are a couple of disadvantages in this chart. So a reader will not understand which data set belongs to secondary axis and which data set belongs to primary axis. For example, this lines has to be read from right axis and the numbers has to be, or the growth, the bar chart has to be read from left side axis. So unless you tell the reader, he will not understand which chart belongs to which axis. So for that, what we can do is, as a standard practice, which is an industry standard practice, you go to the sales growth number, you can say that percentage, put a hyphen and tell RHS, which reads as right hand scale. Similarly, profit growth, in the heading you go there, after percentage, put a hyphen and say RHS. So now what we have achieved is, if you see here in the legend I have told that it is in RHS. So the reader will understand this lines belong to RHS and wherever it is not mentioned, it belongs to LHS or the primary axis, right? So to make it even slightly better, we can do a couple of things. These are all cosmetic things. Go to click on the chart. Once you click on the chart, you will see these three new tabs arriving: design, layout, and format. Alright. So go to layout, go to legend, and put the legend at the bottom. So it goes here. So the chart looks probably lengthy and more interpretable. If you want, you can put a heading also here. I can go here, go at chart title. Where do you want chart title? I want it above chart. I put it here and say I give a relevant heading. I say Infosys Financials. Right? So I put the heading, and if you want, I can slightly expand this chart also. And now this chart looks slightly more readable and presentable. Right? So that is how you have to work with presenting data. The objective of any chart is the reader should automatically understand what you are coming to tell. So here you can tell that the sales have been consistently growing, whereas the profit has been stagnating, right? As a growth number, if you see, the sales growth has been tremendous in 2011, but after that it has been declining, right? Similarly, the sales growth has been declining, net profit growth has been declining. So these are the kind of interpretation that the reader can automatically have. So this is how you have to choose a chart when you are presenting a financial data, right? So you can use any other chart as long as you think that information can be presented in a logical way. Fine. So let's go to the next case study, which is on PE band chart. So let's understand first what is a PE band chart. So you have a example figure here, which is a PE band chart of Infosys. So this green tick line is the actual price, of Infosys. The lines that we have here, which is PE 13.5, 15.9 and 22.7, are prices if PE has been 13.7, 13.5. Prices if PE has been 15.9. Prices if PE has been 22.7. So this line says what would have been the price if PE is always 22.7. This blue line tells what would have been the price if PE is always 15.9. This line tells you what would have been the price if PE is always 13.5. So what is the advantage of this chart? So you can, by drawing this chart, you can roughly say that where does the price generally belong to. You can say that the price generally belongs to this range of between 15.9 and 22.7. Whenever the prices go above 22.7, it generally comes and settles in the range of 15.9 and 22.7. Whenever it goes below 15.9, it bounces back strongly after a period and it comes back to this range, right? So this is the interpretation that we are looking for. So generally, a fundamental analyst or even a trader will decide that whenever a stock price is not in the range of PE between 15.9 and 22.7, it is a time to buy or sell. So if the PE comes below 15.9, one should buy. If a PE goes above 22.7, one should sell. So this is an easy way of explaining that. So the moment we see this chart, we will understand that. So whenever this range breaks, there is a price appreciation here or a price correction here. So that is the advantage of PE band chart, right? So but drawing this is not that easy, right? So we'll see now how to draw a PE band chart, right? So let's go here, see what data we have. We have been given this data. We have been given the actual price data from 3/1/2011 to 6/1/2014. We have been given quarterly EPS. Now we have to find out, this is all trailing EPS, trailing 12-month EPS. That is, if I say as on 1st January 2012, as on 1st January 2011, my trailing 12 month EPS is 111, then I am saying from 1st January 2011 to 31st December 2011, the total EPS, the EPS for this 12-month period is 111.38. When I say on 1/4/2011, the trailing 12-month EPS is 114, then it means that from 1st April 2011 to 31st March 2012, 1st April 2011 to 31st March 2012, the EPS has been 114.84. So that is trailing 12-month EPS. But why does it change only once in a quarter? Because companies report income statement once in a quarter, P&L account once in a quarter, right? So and hence once in a quarter this number will change. So we have been given quarterly trailing 12-month EPS, right? So let's go ahead and see how we can work around with this number and do a PE band chart. So first I will connect it to the date. So for the purpose of comfortability, I will connect it to the date, which is here in the range, from the price range. So I have connected it. So now this is date. Now I have to take trailing 12-month EPS for a given date. So for an entire quarter it will not change. For example, from 1/1/2011 till 31/3/2011, let me write it. From 1st January 2011 to 31st March 2011, this EPS of 111.38 will hold good. Similarly, from 1st April 2011 to 30th June 2011, this EPS of 114.84 will remain same, right? So how to get the TTM EPS in this table? So let's get this. That is not a difficult task. So we all know we would have used a function called VLOOKUP. So VLOOKUP, search for this date 3/1/2011. In this table array, select this entire table array F4, and if the date matches the first column, pick the relevant data from the second column. And range lookup is an argument whether you can say whether you want an exact match. So find the exact match or you want the closest match. If you want the closest match, you have to put true. Otherwise you can put false in this range lookup argument. So now I want the closest date only. I don't want the exact date. So what I can do is I can put 1 here. 1 is equivalent to true. So I will put 1 here. For all the purpose of Excel, 1 is equal to true. The moment I type 1 here, you can see the word true has come here, right? So I put 1 here and the word true has come here. So I put here and enter. So I get this 111.38 here. So I drag this. So let's move down and see what happens. So the 111.38 remains same till 31st March 2011. On 1st April 2011, it changes to 115, which is actually 114.84. So for the next 1 quarter, till 30th June, we can see the same number. On 1st July, this number will change to 116, which is the EPS we see here, right? So this is the advantage of VLOOKUP. You can have both exact match and closest match. Alright, so when I used closest match, I was able to take the same EPS for entire quarter. So that is the advantage I had. So now I had found out TTM EPS. I have found out TTM EPS. Now I have to find PE of 13.5 and PE of 15.9 and PE of we also have other PE, right? So we have PE of 22.7, right? So we had 3 PE ranges basically, 13.9, sorry, 16.5, 19.2 and 23.5. This is what we need to find out, 16.5, 19.2 and 23.5. 16.5, 19.2. So 16.5, 19.2, 23.5. So now I have to find what would have been the prices. So let me put it here actually. So what would have been the prices if PE has been 16.5, 19.2 or 13.5. So we know that price divided by EPS is price earnings ratio. When we say that price divided by EPS equal to 16.5, and we know the EPS, in this case it is 111, right? So price divided by 111 equal to 16.5. So we can find the price now. We can find the price if EPS has been 16.5. So if EPS has been PE has been 16.5, our price would have been 16.5 into 111. 16.5 into 111. If PE has been 16.5, our price would have been 111. If PE has been 19.2, the price would have been 19.2 into 111, right? So this is how you have to calculate what if prices for a PE band chart. So let me go ahead and calculate those what if prices. So 111 is the EPS, 16.5, I freeze the top number, right? And then I calculate this. Sorry, I also freeze the leftmost column. Now what this tells me is if the PE has been 16.5, the price should have been 1837. If the PE has been 19.2, the price would have been 2138. If PE has been 23.5, the price would have been 2617, right? So now we also have actual price, isn't it? We also have actual price. Let's put that actual price. Actual price. We link it from the table we have. So we have actual price and we have the what if prices. So let's drag the formula. So for the entire series, we have actual price and we have what if prices. What if the price has been if the PE is 16.5, 19.2 and 23.5. Right? So we have calculated that. This column may not be required. So now let's draw the chart, select the data, insert, line chart, and we have the line chart in front of us. There is this EPS column which is not useful. So I am going to delete that EPS column here. Right? So we have dates and we have PE band chart. So we have to make this bit more useful. As of now it is very ugly. So we'll make this bit more useful. I'll go up, paste the chart, and how to make this useful is right click, go to select data, right? So series 2, what is series 2? Series 2 is actual prices. So I'm going to edit this and say series 2 is called actual price. And what is series 3? Series 3 is PE of 16.5, right? Put that within quotes. The next one, the series 4 is PE of 19.2, PE 19.2. The next one, edit the next one, it has been PE of 23.5, right? So we were done with this, and now let's say OK, and now the scale below 1500 there is no value required. So I will adjust this scale, right click, select the scale, right click, go to format axis and axis options. In the minimum value I will change it to fixed and say I want a minimum value of 1500, and the maximum value I would want is, let's say, 4000 only, right? So now this chart looks bit more readable. Still this values here is bit more congested, right? So I will make this better. click on this x-axis, right click, go to format axis. First go to the number and create a custom format and say you want a format which is, or you can actually go to number, date and say you want this format DDMMYY, or you can go to custom format and say whichever format you want, right? So axis options, number, custom format, I'm going to say I want only month name and year name, right? So I had this, okay, number, custom, why is this not coming? Just give me a moment. Array. Format axis, number, go to custom format and say MMYY. Why is it not changing? Custom, okay, now we have this and I am going to use this array. Sorry about this, for some reason this is not working. Okay, this is not working, so no harm, but we can still make it better with, say, right click on this, select x-axis, format axis, number, sorry, axis options, and then say it has to be specified at an interval of, let's say 100, right? So which will make it slightly look better, right? So let me make this better by, just give me a moment. So this has to be taken down, right? So format axis, number, and now I have to create a custom format with MMYY, and once I select this, I select this and go to format axis again and axis options, and here I will say the major units is after 3 months. So here now you can see it once in 3 months, the x-axis is a bit more spread out, right? So this names have now changed, no harm, we can put it again. So go to, select this chart, right click, change chart type, not change chart type, select data, select series 1, edit it and say actual prices. The second one, edit it and say PE 16.5. Third one, edit it and say PE 19.5. Fourth one, edit it and say PE 23.5. So now you have the chart, complete chart. So this will make us understand what is the range, PE band range for this company. So now you can again clearly see that where the price stays most of the time. The price stays most of the time in between this blue line and violet line. So this is the advantage of PE chart. While it is a bit tedious to create this chart, this is a very useful chart and most widely used chart. You can also give a heading, select this, go to layout, chart title, above chart, Infosys, PE band chart. Right? So this is how you can work with a PE band chart. Right? So now let's move on to the next stuff, which is sensitivity. So here in this case we have been given a case study wherein a client has been recommended this portfolio allocation: large cap 40%, mid cap 25%, long term bonds 5%, short term bonds 15%, and liquid bonds 5%, gold 10%. There is a spelling mistake here. It should read as SHORT, right? So this is the recommended asset allocation. However, while the analyst feels that base case this is going to be the return, it can vary in any of the range. In worst case, a large cap can give minus 10% and mid cap can give minus 15%. Whereas in best case, a large cap can give 28% and a mid cap can give 35%. So an analyst wants to present the range of potential returns that the company will generate. So how to do this sensitivity analysis? So there are more than one ways to do it. So I will present one of those ways, one of the simplest ways. I will not discuss about the toughest ways, which is more dynamic. So I will discuss only the easiest ways. So you can use some product. This is the range of asset allocation and this is the range of possible returns, right? This is the range of asset allocation and this is the range of possible returns. So you do that, you will get minus 7.1%. What we exactly did? So for example, let's say for the base case or for the worst case, these are the returns. I put it here. So the worst case returns are actually here. Then what I exactly did was I multiplied the percentage allocation into percentage return. I did it for all the cases and then I added them, which gave me minus 7.1%, which is what I did here in one step. I used some. So basically what I am doing is I am first finding the product and then I am finding the sum. So the sum product function essentially does both of them in one step, right? So that is sum product function. So this can be replicated easily. So let's say I am freezing this also. So this can be replicated easily. So you select this, drag the formula. Now you have to press F2 and move it from worst case to worst case. In the third column, press F2 and move this yellow line that appears here. Select it and drag it to base case. Third line, select it and drag it to better case. Fourth line, select it and move the green line that appears here to best case. So in this way, you can quickly present a sensitivity analysis. While I do agree that this is not the most dynamic way, this might be an easier way. The most dynamic way is to use a table function here. So if you go to data, what you can see here is a what if analysis tab here. So in that what if analysis, if you go here, you will see a function called data table, which will help you to do the sensitivity analysis in a more dynamic way. But I'm not going to discuss that now because of lack of time. So let me move to the next case study, which is on performance attribution. So here we have been given a set of money invested in the portfolio. That is on 1st January, 1 lakh has been invested or 1 million has been invested. Again on 25th March, another 200,000 has been invested. On 27th July, 100,000 has been withdrawn. So on and so forth. So the final portfolio value is 1.53 million. Portfolio value before action, that is, you invested 1 million on 1st January. On 25th March, before you invested this 200,000, the portfolio value is 1.04 million. Before you invested this. After you invested this, it would have increased, but before you invested this, the portfolio value was 1.04. Similarly, you added 200,000 to this, which made it 1.24 million. On 27 July, before we withdrew 100,000, the portfolio value was 1.302 million. So we have been given the portfolio values before action. And we also have been given benchmark value for that period. and we know what is the benchmarks return during the period, right? So that has been done very easily, and we also know what is the XIRR for this period. We have calculated the XIRR for this period. But however, what is the bone of contention here? The bone of contention here is the portfolio has underperformed the benchmark. So the benchmark has given 29.7% in this 1.5 years, whereas the portfolio, the IRR is 19.24%. So the first question is whether the portfolio underperformed. Whether the portfolio underperformed. That is the first question. 2, if it has underperformed, whether it is because of fund managers' poor management or it is because of untimely withdrawal of cash flows. Untimely cash flows. See, for example, when a client withdrew this money or invested this money is not in the hands of fund manager. Because whenever the client wanted, he came and withdrew the money. Whenever he wanted, he came and invested. So this might be a wrong time to enter or exit. So we want to segregate the fund manager's performance from this client's intervention in the portfolio. So how to do that? So these are the questions in front of us. So to answer the first question, has the portfolio really underperformed? For that, this is not a direct comparable. Why? Because this is an absolute return. This is a return for 18 months. Whereas this, as you can see here, is an IRR. So this is an annualized return. This is an annualized return. So you can't compare an absolute return and an annualized return. So first you have to convert this IRR into absolute return. So let's do that. So how to make it annualized? So first we have to find the number of periods in the years in the above period. So 30th June minus 1st January 2012 divided by 365 will roughly give us 1.5 years. So you had 19.24% per year. So for 1.5 years it should be higher than 19.24%. Power 1.5 minus 1. So if it is for 18 months, the performance would have been 30.1%. So actually the portfolio did not underperform much. The portfolio's performance is 30.1. But still, we do not have an answer for whether the fund manager did well. It could have been because of this client's intervention. Probably the client's intervention made him the money rather than the fund manager. So we have to find out whether the fund manager did well. Right? So we have to segregate the fund manager's performance from client's intervention in terms of investment and withdrawal. So how to do this? So for that we have to understand something called, there are two types of return which for a portfolio. One is time weighted return. One is time weighted return and another one is money weighted return. Most of the textbooks do not teach this, but let's understand what are this. See, a time weighted return can be influenced by this kind of cash inflows and outflows. This time weighted return can be influenced by cash inflows and outflows, whereas a money weighted return will not be influenced by cash inflows and outflows. So an effective fund manager's performance will be given by money weighted return. So the effective fund manager's return can be found out only using fund managers money weighted return. What we have found out using this IRR methodology is actually a time weighted return. So IRR is actually a time weighted return. Why do we say it is a time weighted return? So let's see I will change one of these dates. Instead of 14th March 2013, let's say I am changing this to, let me slightly make it bigger. Instead of 14th March 2013, let's say I am changing this to 14 May 2015. See here, the number here now is 19.24%. So I am changing this. this number changes to 18.91%. So when I change the date, the returns will get influenced because the timing of the investment do matter here. That is why it is called time weighted return. On the other hand, the money weighted return will not change for this kind of change in dates. So let's go ahead and calculate that. How to calculate that? So for that, we have to first calculate. We know that what is the portfolio value and what is the portfolio value before action. We have to calculate portfolio value after action. So portfolio value after action on first day has been same. The second day has been portfolio value plus the amount invested or withdrawn. So portfolio value after action has been this much, and the final portfolio value is 1.53 million. So first we calculated what is the portfolio value after action. Then we have to calculate something called holding period return. We have to calculate something called holding period return. So the holding period return can be calculated as the portfolio value before action divided by the portfolio value after action in the previous period. So here what we are doing is actually the ending portfolio value as of 25/3/2012 and the starting portfolio value as of 1/1/2012. So which gives us 4% return. So for this close to 3 months, the portfolio earned 4%. In the second case, for this close to 4 months, the portfolio earned 5%. So like this, you have to calculate for all the periods. So once you calculate the holding periods, I have not subtracted ones here. So ideally, if you want percentage, it has to be -1. So you get 4%. But I have not done that for a specific reason. So the holding period return in this case is 4%. For this 3 months is 4%. For this 3 months is for this 4 months it's close to 5%. For this whatever 3 months it is -3% because less than 1, right? For this 3 months it is going to be -2%. Here it is going to be 8%. Here it is going to be 10%, and here it is going to be 4%. So these are various holding period returns. So once you find out this holding period returns without subtracting this ones, all you have to do is take a product of them. Product of this, which gives us 28% return. So now you can see that the portfolio manager's performance is 28.25%. Now let's go ahead and try and changing these dates. If you change this date to let's say 14th May 2013, this return will get changed to 18.91%, but this return never changed. So since the IRR can be influenced by the timing of the cash flow, it is called time weighted return. Whereas since this cannot be influenced by time, it is called money weighted return. And as I said, to measure a fund manager's performance, a money weighted return could be better. Alright. So now let's go ahead and segregate this. So portfolio return without transactions is going to be 28.25%. So the actual portfolio return is 29.6%. If there has been no transactions, the portfolio return has been 28.25%. Right? So what is the loss because of transaction? The loss because of transactions is this 1.3%. So the benchmark's return has been 29.7%, and hence now you can say that the fund manager has actually underperformed the benchmark by 1.5%. So let me quickly repeat. Alright, so let me quickly repeat. So the portfolio's return, overall return has been 29.6%. If we adjust for all this timing of the cash flows, the portfolio return has been 28.25%. So without any of these transactions, the portfolio return would have been 28.25%, which means because of the transactions, the portfolio lost 1.3% return. So for the purpose of comparing fund manager with benchmark, this money weighted return has to be used. So the benchmark actually has performed 29.7%, and hence if you take the difference between benchmark and money weighted return, you get 1.5% underperformance. So you can say that the fund manager underperformed the benchmark during the period because of this, not because of this transaction, but because of his own poor performance. So the fund manager's performance is poor for this period. This is how you can segregate a fund manager's performance from a portfolio's client intervention, right? So time weighted return and money weighted return will be useful in this purpose. So let's move ahead and do our last case study. Here we have been given certain data points. So we have been given the standard deviation of certain stocks. We have been given the correlation of those stocks with portfolio. We have been given what are the expected return of this portfolios, expected return of those stocks, right? We have been given what is the benchmark return, benchmark standard deviation and expected return, and we also have been given what is the risk-free rate during this period. So what our task is to design a portfolio, which will give the highest trainer ratio, So now let's understand what is trainer ratio. Trainer ratio will be given by portfolio's expected return minus risk-free rate divided by beta of the portfolio, right? So this is the portfolio's trainer ratio. So now before even getting into this, let's also understand what is Sharpe ratio. A Sharpe ratio will be given by portfolio's expected return minus risk-free rate divided by standard deviation of the portfolio, sigma d of the portfolio. Alright, so this is how you have to maximize the portfolio. So there are optimization techniques that are available for us here. So let's go ahead and do this. So first let's calculate the beta. What is the formula for beta? Beta can be calculated as standard deviation of stock into standard deviation of the market into correlation divided by standard deviation of the market square. Standard deviation of the market square. This is the formula for beta. Let's go ahead and calculate the beta. So we know standard deviation of the stock. We know standard deviation of the market. I freeze this. We also know correlation coefficient between stock and market divided by standard deviation of the market square. So we get beta of the stocks as this. Infosys has a beta of 1.85. I haven't frozen this. That's why there is an error. Right? So I have been getting these as betas. So now to start with, let me put some dummy weights here. So I am putting some dummy weights. I put 12.5% per stock. So the total portfolio weight is in this case is going to be 100%, right? So now let's find out the portfolio beta. So portfolio beta is nothing but sum product of this and the weights, the individual stock weights and individual stock beta. So the portfolio beta is 1.15, right? Now we have to find out the trainer ratio. For that we have to find portfolio's expected return. We have to find portfolio's expected return. Again we will use the sum product formula. Sum product, the weights of the individual stocks, comma, expected return, right? You get 15.4. So what is the trainer ratio? Trainer ratio will be given by portfolio's expected return minus risk-free rate divided by beta, right? So we get a trainer ratio of 0.06 to start with. Now we have to optimize this, meaning this trainer ratio has to be as maximum as possible, right? So how to go about this process? We have a tool called solver. So click this data tab, go to solver. So what is your objective? I want to maximize this trainer ratio. So set as an objective, select this trainer ratio and say you have to maximize this. By changing what? By changing this portfolio weights. This portfolio weights can be anything between 1 to 100. Are there any constraints? Yes, there are constraints. So this stock weights has to be between 0 and 1. It can never be less than 0, right? You can have 0 allocation for the portfolio, but it cannot be less than 0. So I will say that it has to be greater than or equal to 0. The stock weight has to be greater than or equal to 0. The second constraint is the sum of all these weights, which is here, should be always equal to 100%. It can never be, the total weight of the portfolio should always be equal to 100%, right? So are there any other constraints? For now, let's keep this and let's run the optimization. Now I am going to say solve this. When I solve this, obviously all the stock weight get into ITC. Why? Because ITC has the highest return for a given beta. It has lowest beta and highest return. So everything went into ITC. So I want to ensure at least 3 stocks are invested in, right? So at least 3 stocks are invested in. So what I will do is I will use a countif function and say if this range is greater than 5%, then count them. So as of now, there is only one stock that has greater than 5% allocation. So now I want to keep it at least at 3, right? So I can do this by going back to solver and adding a constraint stating that this number has to be greater than or equal to 3. So I add this and try to solve this. So now solver says it could not find a solution. So this is the biggest drawback of solver in Excel. While in the first case we got a perfect solution, we cannot use this solver for optimizing in this case. Why can't we optimize this? Because Excel solver function works out this principle called maximum and minima. So we all know that this is a non-linear optimization, in which case the trainer ratio with portfolio weights can be going ups and down like this, right? So in this case, what will happen is Excel will have a starting point and try to find the local maxima and local minima. So it will search for an optimal solution only within this range. The starting point is somewhere here, it will search for an optimal only in this range. If the starting point is here, then it will search for an optimal ratio only within this range. It will not go beyond this. That is the problem of Excel optimization. While it will work in most of the cases, there could be cases wherein the Excel's optimization tool will not be useful, right? So this is the learning of this case study, that solver cannot be used to optimize tools wherein it's a non-linear optimization and the local there are a lot of local maxima and minima, then it will not work. For example, let's say I am going to put some other starting point. I am going to put a starting point of, let's say, 36% here and let's say 64% here. Let's see whether it finds a solution. Solver, solve. Solver still could not find a solution. Let's say I am putting 31% here and put a 5% here. Let's see, now it solves. Solver has now converged to a solution. So depending upon where I start, the solver's optimization solution can change, right? So earlier I put 12.5% everywhere and solver said it cannot solve. Now I had a different starting point, that is from 27.9, and I put 31 and 31, 64 and something, 31, 64 and 5%, isn't it? Now when I click solve, it has solved. It said solver could find a solution. So now what has happened is the solution has been like this, isn't it? So when I put 12.5%, it was searching for a solution here in this range and said it could not find a solution. Whereas now I gave the initial starting point somewhere here, and hence it could find a solution. That is the drawback of Excel optimization tool. So if you are using optimization tool in Excel, then be careful. It may not give the right solution always, right? So that brings us to the end of our discussion on case studies. If you have any queries, you can type here. I already see a lot of queries. I will take them one by one, right? So if you have any queries, you can type. You can type your queries now. If you do not have any queries, please type no. Yeah, go ahead, type your queries. Yeah, Arjit, go ahead and type your questions.